dich in die Mitte.
Ja. Gut. Danke.
Thank you. Good morning. It's Alistair Ryan, Bank of America. I feel bad asking a detailed question after some very impressive opening comments, but I'm going to ask a detailed question anyway. Costs. Is there more than 10% return on tangible equity for 2020 dependent on the positive jaws, or
no, not on the positive jaws, no.
And then secondly, this might be later in the day, but how do we think about the level of sort of investment? How constrained is your digital investment within that? Clearly, you've done a great job so far, but are you moving as fast as you would like on digital, or are you moving as fast as the P&L will absorb? Thank you.
Well, I think we go into detail a little bit later on that, but I think what is important is that we're doing the right things in the right sequence and in the right logic. And I think the strategy in itself, not to go for a huge pan-European core banking replacement, but rather sort of being more flexible is the right approach, which then translates into a lower cost updrift than we would have seen if we went for a big thing, which we think is the wrong thing to do. So I think what is important for us is the right topic, the right strategy, and the right sequence.
Hi, it's Gabor Kemény from Autonomous Research. Firstly, on capital, can you give us an idea, a bit of clarification on your dividend payout guidance? So you are saying up to 50% ordinary. Shall we read it that if you are above a 13.5% CET1 ratio, which I understand is your target, you would be willing to pay out 50%, or are there other drivers to consider? Secondly, on CRD5, if we get a capital requirement increase from the movements in the buffers, how much room do you see for your management buffer to absorb this possible uplift from the increasing capital requirements? And lastly, on costs, I think you indicated an about 140 million increase coming from personnel costs and IT costs next year, and you also talked about a large part of the cost increase coming from the savings banks actually in past years. Can you give us an idea how much of the 2020 cost updrift might be coming from the savings banks? Thank you.
Maybe I start on the dividend policy and the payout ratio. Yes, we have confirmed our core equity tier 1 target of 13.5. Which does not mean that whenever we exceed 13.5 and we move to 13.6 that we would pay out a special dividend or buyback shares. So I think 13.5 is what we want to hold at all times, and considering excess dividends would be a matter of significantly be above 13.5.
14 actually, yeah.
Yeah.
And I mean, what do you mean with regards to the 50% payout ratio? I mean, this is of course a number that is a good indication, I would say. But you know, overall, given the fluctuation of results, even it's not the absolutely key matter. The key matter clearly is our capital core equity tier 1 target. And of course, the fulfillment of the regulatory requirements plus the buffer. Now, answering your question with regards to the buffer, obviously, which I personally do not believe, but you know, who knows? So to say forecast regulators is not an easy task. Should there be an increase in the dimension which would, you know, really eat fully into our management buffer? By definition, you would have to review it and readjust it. So in other words, if there's a burden of additional percent, which I don't see, but just in theory, because that's your question. I mean, I cannot stick to the same buffer because there is no buffer anymore, by definition.
Well, not so much.
Yeah.
There's some. Yeah.
No, of course, yeah. So that's exactly the answer to this discussion. That's why we put it on. I think Bernd Spalt was in a very intensive discussion recently. We are very optimistic that this this idea, which was flying around here and there, will not become material at all.
Maybe just to add on that, if you look at the structure, on a CRR level, the probability that the setup will be changed, that these two buffers, OC and SI, would be cumulative and not the higher of, which will come into force at the end of 2020, the probability that this wording or concept will change is not high. Where we see a lot of room to maneuver is on the local implementation side. So the Financial Market Stability Committee in Austria has it in its power to make an assessment on what the combined buffer regime will look like. And we had discussions now with the top management of this committee, and they are well aware of what they're confronted with, and they are now recalibrating the buffers individually, because they understand that at the time when these 2 and 2% have been introduced are now much different. The spillover effects have been very much contained, cross-border funding is different, and the NPL structure is very different. So they do understand that this is a different situation now. They are working now on a recalibration of the buffer regime, and we will know for sure by the beginning of next year.
Good morning. Good morning, Anna Marshall from Goldman Sachs. First question is on your growth ambitions. Looking across your footprint, which markets do you see as the most attractive in the medium term, and hence where do you want to grow the most? And my second question is on your potential consideration of M&A. In which markets do you see the most scope for in-market consolidation? And also, is expansion via digital still an option? Thank you.
Maybe I start with the growth. I do not think that the growth pattern will change massively when it comes to cross-country constellation. Also not retail versus corporates. I think corporates over the last year or so has grown more than we would have thought. So I think forward-looking a little bit more balance between retail and corporate. But there is no country where we would say this is specifically more inclined to grow than to the other. There is a very strong correlation between GDP growth and loan growth. This full employment will continue to be around, so consumption will still be high. So we will capture growth opportunities in all of these markets. There are two markets where macroprudential measures have been implemented on two levels, one on the buffer side and then on the underwriting standards, so the regulators are responding. But what we're saying is we see growth potential in all of these markets and we will exploit them.
Oh, hi, it's Alan Webber from SocGen. Within your target to grow fee income by this sort of 3.9% over the period, are there areas where you expect there to be shrinkage of fee income in terms of digitalization, making transaction costs lower, a competitive environment? So, is what we're talking about a much higher growth in asset management fees, bank assurance, and some drag from basic banking businesses as you get more digitalization? The first part of the question. And the second question, I mean, you've talked for a number of years now about shifting retail savings into asset management products, and you're actually talking about structured products and selling structured products to retail clients now. Have you got over the complexity and the compliance risk of doing that? Because clearly, up until now, you've been taking no compliance risk. You're now talking about more complex structured products. And I wonder how you see that in what is clearly a very, very tight, consumer regulation, consumer protection market, and what do you think the risks to your business of making that change are going forward?
Maybe I take that question first. I think it's not a short-term task which we're putting on to shifting these excess deposits to asset under management, but it's strategically the absolute conviction of us that we will go that way. So this will be a strategic priority, and we put emphasis and energy and capacity on that. When it comes to, so it still is a long-term target, and it will continue to be so until interest rate situation will be different. Now, when it comes to compliance risk and complexity of the products, I think it's more a conduct risk than a compliance risk, possibly in terms of what kind of products we can meaningfully sell to a broader population. So yes, the underlying risk needs to be well understood, and it needs to be explained in a way which is apt for a retail customer. This is a challenge. It's a challenge in terms of educating our own staff. It's a challenge in terms of educating also our customer population. Because the idea of a risk-free investment is not here anymore. So what we need to do is explaining to a broader population that while in the past depositing money at the bank has been considered as a completely risk-free way to save, this is now over. So a broad population needs to understand that you need to take some risk, which we need to be able to explain. You need to also employ a long-term rather than a short-term view. So it's really all about financial literacy and education, and as such, a long endeavor. But I think we're aware of the conduct risk, and we will not sell funny stuff to our retail customers, to make that also perfectly clear. On your first question, the answer is a yes. There will be drag on our fee income, not only from digital offerings becoming more cheap generally as a commodity, but also because of SEPA. Stefan has mentioned that in the beginning. There will be pressure in the amount of something like 20-25 million next year from SEPA alone. So yes, there will be counterbalancing effect. So the 3.9% compound annual growth rate, which we are committing to, is a very ambitious target, yes.
Morning, it's Sam Goodacre from JP Morgan. I've got a question on capital, and it relates to potential M&A. So you have said that M&A wouldn't be a focus, but you are willing to sort of look at various transactions. And if something like mBank were to materialize, it obviously would have a significant impact on capital. So what are your views around funding such a transaction from a capital perspective?
Should I? Thanks for this question. Many of you have been participating in our call after the Q3 results, and actually at this point in time there is really nothing to add with regards to mBank, other than, of course, however the transaction will be structured, and as most of you know, there's a lot of uncertainty around also the structure of the transaction, be it with regards to the Swiss franc portfolio, be it with regards to how they actually really want to structure it between the seller and the buyer. Parallel to that, there is still, just to add this also, the insurance deal which is going on in Poland, bumper top. So whatever would happen, which would bring us closer to this transaction, means a significant capital transaction. So market talk is subject to the structure that we talk about 2 billion, 2.5 billion of volume. So should we, which is I would say an average likelihood, should we come in a position to really discuss a capital increase, this would have to, this would trigger a significant work with our investor base. When I mean our investor base, all our investor base. That's completely clear. Most of the other potential in-country options that we have been asked about and that we have been having a look at are, on the one hand, have very little concrete aspects in the moment. You know that, for example, Hungary, which we regard, also coming back to this growth question before, as a very attractive market in the upcoming years, has been attractive. We see a very good positive outlook there. So definitely, should Budapest Bank be in any form in a normal sales process an option, we would look into it. Doesn't seem to be. So for all these other transactions, we talk about completely different dimensions in a factor 1 to 10 in most cases. Nothing is on the table as we speak.
Yeah. Hi, Tang Leifung from Concord Securities. Just a follow-up question. So first, asset management is a key element of your strategy. So which countries you see like the largest potential that you have in asset management? And you calculated with some 4% average growth. So is it market share gain mostly, or is it like?
I can be very brief on that. It has to be a combination of both, number one. So meaning, that's what I also mentioned in my presentation, there needs to be a development not only of the asset management activity, but this goes along with developing capital markets. Definitely a prior focus of us, not only as a bank, but as an overall institution in the society. So it definitely has to go hand in hand. We have to gain market shares here and there, but the major part, of course, should also come in, especially in those underdeveloped markets, from developing the market. Now, realistically speaking, for the period that we are talking about, we will not generate these amounts and this growth in Romania alone, right? So in other words, of course, Austria, Czech Republic, Slovak Republic, Hungary has been always a quite intensive market on asset management, are the 4 countries which are there in the leading position and where we can build on a stronger base already. But the long-term plan is, of course, to develop also the less developed markets in the area of asset management.
And also on mBank. So I think it's a very good digital bank. Of course, they have the CHF portfolio. But have you calculated some synergies, or would you be able to implement their digital technology to other markets?
I leave the digital either to Bernd or to the colleagues who are going to discuss digital anyways today with you. Synergies in terms of an in-country synergies, obviously there are none. That's definitely also a disadvantage that we have versus some other potential bidders. We are aware of that, and this comes without saying. So synergies with regards to the digital product, I kindly ask you for understanding. Please address it to the colleagues who know the product. They can give you more color on that.
I also think it's much too early to talk about that. As we said, there's not even an info memorandum on the table. We know nothing more than what is available in the papers, so this is not a time to discuss this, I think, properly.
Good morning, Martin Amesh from UBS. I have 2 numbers questions. Apologies for that. Firstly, on the securities portfolio, thank you for the details on the 2020 impact. Would you be able to share with us the impact longer term, assuming a full rollover of the securities portfolio? So the drag in 2021 and years afterwards?
So can I answer that immediately? Not shooting from the hips, but we can. To all my knowledge, this is an indication only, to all my knowledge from earlier analysis, the biggest drop has always been on 1920 and partly into 21. Simple for the reason that a lot of the higher yielding assets are expiring, but I cannot give you numbers now. Clearly we can follow up with that for the years to come. Always it needs to be seen, of course, at the level of reinvestments. The drop is going to slow down, but it's not going to go up, of course, as long as the rates and the reinvestment levels are as they are.
That is already helpful. Thank you. And the second question is on costs and the 300 million IT investment costs that you flagged over 5 years. Is it fair to assume that is more front-end loaded?
No, this is basically this is definitely not front-end loaded. This is very much I would call it this typical middleware area plus step by step, we call it containerization and improvement on the core banking systems. Mr. Spalt has been outlining that we are not going, and I think it's very smart not to do so, into any huge core banking system renewal or substitution. However, of course, the further development and renewal of significant parts, modular parts of the system are of critical importance. So no, these 300 million are explicitly not the parts which we would discuss in the front end, digital investments and so on. This is in a, I wouldn't say in a separate topic, but it's a separate pocket, but this is independent from that. Progressive IT modernization is mainly addressing mid to back office area, middleware and core banking.
Thank you, that is clear.
Thanks for the presentation. It's Hadrian Debel from KBW. I have two questions, please. The first one is, you said it's time to address the cost base in Austria. Could you elaborate a little bit more on that? And the second question is, you flag NII growth of 0 to 2% for next year. Which country is growing at 0? That would be my two questions, please.
Okay, I can take the first one quite easily because I know since my last job was CEO in Erste Bank Österreich, and I know who is running this bank now together with the local CFO. So we have been already, and if you look into the numbers of the Austrian entities, so in terms of segmentation, we talk about partial group EBÖ, as well as so-called other Austria. And if you look at the cost development there, we have been in a very strongly growing top line development. We have been pretty good in flattening out the growth of costs versus what we had in 13 to 15, 16, if I remember correctly. That will not be enough in our view. In other words, my clear goal is that we will keep the costs on this part of the Austrian part. I cannot speak for the savings banks because it's simply in my hand. I personally believe, knowing a lot of people there, they will follow, but I cannot, fully guarantee any development there. So our clear goal is to keep costs flat in the partial group EBÖ, and on the holding side, we have already kicked off initiatives strongly, not only the three of us, but also the other colleagues, to start investigating exactly which numbers we can also communicate. Yeah, I'm not in the position to give you a number for the overall Austria. I know that in the partial group EBÖ, the goal is to keep costs flat over the observation period.
On the NII side, I don't think that this is a matter, will one country have a 0 and the other country a 2% growth. NII is a function of loan volumes, margins, and our reinvestment challenges or opportunities. So all of our countries will still grow their loan book. All of the countries will have some pressure on margins. So some of them will be flat, some slightly under pressure, but all of our reinvestments will be negative in terms of comparison to the existing book. So there's not a country specific here. I have structurally less NII.
Okay, I was flagging that because we know some of the big countries will grow much faster than 2. Hence, to make the 0 to 2, you need some to grow at 0, and that was my point.
That's correct.
Okay, and then just to follow up on the cost base, when you mentioned Austrian cost, is that like 700 million euros cost base that you discussed?
Yes.
That's the 700.
Yes. Perfectly right. So it will very likely will be slightly higher this year, but this is exactly the number, 700 ceteris paribus. So in other words, if no change, there is no change in the scope of the partial group, but that would be easy to follow up. Then it's exactly this number. Yeah.
Okay. Thank you.
Yeah, hi, it's Tamás Menyát from Erste Asset Management. I have 3 questions. So one on the cost side, you showed us the slide with branches coming down 20% or so since 2009. So here my question is, going forward, how important are branch reductions for actually reaching the cost-income ratio target? Second question, it was mentioned that the only countries where you still do FX is Croatia and Serbia. Yeah, so there my question is, do you only lend to people who actually have euro income, or do you do it in general due to the euro-linked economy? And third part, bank assurance, all of you talked about it. Do you have some specific actions you want to take, getting new partners, except VIG maybe, or something like that? Thank you.
Let's start with the FX. So first it relates to retail clients, and it means this is FX lending then, so not to people only that have euro income. Yeah, so it's really FX lending, but in the euro only, so not in Swiss franc or anything else. And those countries, and I'm sure that also our CEOs from Serbia and Croatia will also comment on this in the afternoon. The euro there is the dominating currency. You have all the savings, I think 90% of the savings in the euro, and the overall volume, it's strict, so it's not everything is in euro. There are RAS limits, but the overall volume in Croatia we are talking about is roughly 1 billion and 300-something million in Serbia.
And sort of the future branch reduction is not how shall I say, prerequisite for reaching our cost-income ratio target. This will be a combined set of measures. Branch reduction in itself is not a target. It's rather a reflection of the different customer behaviors. So to the extent, and this is very different from country to country and from regions, and I think Peter will allude on that, we will see a sort of move from physical branch transacted business to digital, and this is how then we will react on it on a branch level. So I think it's not in itself a target for reaching a different cost level.
If you allow, I come back with one sentence to the earlier question, because I just didn't want to shoot, with my first thought, not confirming it. I looked it up, and it's as I expected. The two countries which are not surprisingly affected by the euro interest rate environment the strongest are Slovakia and Austria, while in Austria we expect to have a significant NII increase, significant meaning not zero. Yeah? In Slovakia it looks like it's, given the margin compression that you saw, combined with the interest rate environment, this will be very difficult. Another difficult country with regards to NII is Croatia. In the other countries, as you rightly mentioned, we have significantly higher NII growth in our expectations. Thank you.
Sorry, can you repeat the bank assurance question?
Yeah, there my question was just, all of you mentioned bank assurance as one of the programs to enhance fees, and you mentioned you have the live partnership with VIG. Whether you plan any other partnerships for entering the non-life segment, for example?
No. I mean, it's not typically my core responsibility to answer that, but to all my knowledge, no. And I've been working very closely with the colleagues in VIG in various fields in Austria. So I think Mr. Bosek and Mr. Bleier can perfectly answer that question, because I don't know all the details of their strategic partnerships, but clearly VIG is our core partner, and wherever they have a strong franchise, we cooperate with them, and that's it.
Thank you. This is Olga Veselova from Bank of America. I have 3 questions. One is to Alexandra. The question is about your normalized cost of risks, 30-50 bips. How slowly do you think the bank will get there? And also maybe you can give us more color how you get to this number. Any feeling where it should be for corporate or retail, maybe break down by regions. Mm-hmm. So this is my first question. The second question is, during the presentations you mentioned that IT costs account for 25-26% of total cost base. How do you see evolution of this ratio in the next years? And the third question is about your digital story. I hear you that you prefer not to do core banking replacements in almost all of your countries. So do you think this is a solution for now, for the next 3-5 years, and you may return to this question after that? Or this will unlikely ever come back to agenda because you go for progressive IT modernization, which costs money? So what's your view here? Thank you.
I start with the first one, and I think will be discussed a little bit more in detail in the afternoon. But generally, yes, this is our strategy for now, for the next 3 to 5 years to progressively modernize. We will in the meantime evaluate and assess what kind of opportunities are out there in terms of a new IT platform which is apt for running our business. This is something which is now in an analysis phase for the next 3 to 5 years. We think what we do is enabling us to most flexibly react on the requirements. And you need to understand that also our present legacy systems are in very different kind of stages and have different kind of necessities to cope with. So I think having a flexible and pragmatic approach there is what we have chosen for the next 3 to 5 years.
I'll give you a very short answer with regards to the percentage of the overall costs. I do not expect the percentage to go down in an overall perspective. What I expect is that the mix of investments, and we try to be a little bit more specific than in the past on that. It is always relatively difficult because you have this big bulk of run-the bank costs and so on, but that the mix will change very much. So in the sense of investments into our digital platform on the front-end side, this progressive IT modernization that we're describing on middleware and core banking. And obviously it's the goal. It's not an easy task, but we are committed to do so, to decommission step by step outdated legacy systems. So overall, the percentage will also not go down because if we are extremely successful, and we have been extremely successful the last years in offering a good digital offering and being this transformation of the overall banking business, then obviously other costs for our network, and this has been already asked for in some of your questions, will step by step be reduced and will typically partly be substituted by IT/digital running costs, but hopefully not fully substituted.
Risk costs. So how slowly will they come? So I'm very confident, and we have all commented on this. This will not be next year. So next year we will stay below 20 basis points, also with a little comfort. Longer than honestly, longer than 2020 to predict, it's really hard to say. But my best guess today is that in 2021 we might touch the lower end of our range. Distribution is different between the countries. So the lowest risk costs we have in Austria. So not only EBÖ but also savings banks. And also holdings, so Austria, which is also due to the different product composition. So in Austria, you have traditionally a lower share of unsecured lending and a higher share of mortgage lending. So this is one of the big reasons. Then in the middle field, there is Slovakia, Croatia, Hungary and Czech Republic, and on the upper range, but still below 100 basis points that we expect are Romania and Serbia. And if you're interested in more details, then we can also follow up afterwards if you like.
Thank you.
Stefan Maxian, RCB. Actually, just one question on the numbers. I think you indicated a net profit growth for next year. Would this also hold true if the higher bank tax in Slovakia would not trigger a goodwill impairment in the fourth quarter now?
So the answer is yes. The basis, obviously. So if you want. In that and only in that aspect, the High Court decision in Romania helped. Yeah, because simply this has been a drag of 153 million on this year. So independent from how the political decision in Slovakia goes on, what you're asking is, would have been this without any goodwill impact here, this basis being outperformed in 2020 on a net profit basis? We are very positive, yes. Obviously, it will also depend on risk cost development and positive jaw discussion and so on, but the answer is yes.
Good. It looks like that we have no further questions. Is that right? And that also means that we are almost on track in terms of timing, which is unbelievable. So I would ask you for the coffee break, and we reconvene at 11:45 for our business part of the day.
Thank you very much.
Thank you.